Welcome to the Deep Dive, where we cut through the noise of financial reports to deliver the essential insights you need. Today, we're digging into Mahanagar Gas Ltd MGL, the big city gas player. We've got this stack of Q2 and half-year reports for FY26, and honestly, there's a bit of a puzzle here. On one hand, operational volumes, they're booming. Really strong growth. But then you look at the margins, the profitability, and they took a sharp dive in Q2. It seems, well, counterintuitive. So our mission today is twofold. First, let's really get to the bottom of this margin mystery, why the drop when sales were up. Second, what's MGL's strategy going forward? Especially, around getting their gas supply sorted and how they're thinking about newer challenges like EVs. And right off the bat, we need to set the stage because there's a fundamental change here. Everything we're talking about today is based on consolidated figures. This reflects the merger with Unison Enviro Private Limited, UEPL, which became official effective February 1st this year, though the final order came through more recently. So basically, we're looking at one single larger MGL entity covering all 6 of its geographical areas, or GDAs. It changes the scale of everything.
Right, a bigger baseline. Okay, let's start with the good news then, the operations, the volume. Yeah. H1 numbers look really strong, yeah. Almost 10% growth compared to last year.
Yeah, exactly. For the first half of FY26, the average daily sales volume hit 4.524 million standard cubic meters per day. MMSCMD, that's up from 4.116 last year. So yeah, 9.91% growth overall for the half year.
And Q2 specifically kept that momentum going.
It did. Q2 volume was 4.593 MMSCMD, which is 9.22% higher than the same quarter last year. So consistent, strong demand.
Okay, but where is that growth coming from? Is it just more cars and homes or something else?
Well, CNG and domestic PNG, they're traditional segments. They grew nicely. CNG was up about 7.9%, domestic PNG around 6.8% for the half year. But the real standout, the one that jumped off the page, was the INC segment.
Industrial and commercial.
Precisely. That segment saw its volume surge by, get this, 22.74% in H1 compared to last year. That's huge. It tells you they're making serious inroads converting businesses to gas.
And that needs infrastructure to support it, I guess. Are they keeping up with the digging and connecting?
Oh, yeah. The build-out continues at pace. Total pipeline network is now over 8,000 kilometers. They've crossed 2.94 million household connections, adding over 53,000 just in Q2.
Wow.
And on the transport side, 14 new CNG stations added in the quarter, bringing the total to 485. Plus, vehicle conversions are strong, too.
Yeah, I saw that number, over 1.2 million CNG vehicles now, with something like 27,000 added in Q2 alone. The demand side, the physical growth, it all looks really robust.
It does. Operationally, it's a strong story. They're executing well on expansion. But this is where we pivot.
Right, because this operational success runs smack into the financial picture, which looks, well, less rosy for Q2.
Yeah.
Let's talk EBITDA. Q2 was what, 338 crore?
338 crore, yeah. Which works out to a margin of about 16.5%.
Okay, but compare that to Q1. Q1 EBITDA was 501 crore, a margin over 24%. Net profit, PO, dropped from 320 crore in Q1 to just 193 crore in Q2. That's a massive fall, quarter on quarter. What happened?
Okay, hold on. Before we dissect the Q2 pain, we absolutely have to address that Q1 number, that 501 crore. It was significantly inflated by a one-off event.
Ah, okay. What was that?
It was a reversal related to old OMC trade margins. Basically, an accounting adjustment for past periods that flowed through in Q1, adding a chunky Rs 112.87 crore to the bottom line that quarter.
So nearly 113 crore of that Q1 profit wasn't from regular operations in that quarter.
Exactly, it wasn't recurring. If you strip that out, Q1's underlying performance was already softer. The Q2 drop is still significant, absolutely, but the cliff looks steeper because Q1 had that artificial boost.
Got it. That's crucial context. So to get a clearer picture of the actual operating health, let's focus on the EBITDA per unit of gas, sold the EBITDA per SCM. That should strip out one-offs, right? How did that number move?
That's the key metric here. And yes, it shows the squeeze clearly. In Q1, even after accounting for the one-off, the underlying unit margin was around 12.35 rupees per SCM. In Q2, that dropped sharply to 8.0000 rupees per SCM.
8 rupees. Okay, that's a real drop. So that's the margin compression we need to understand. Management pointed to specific reasons.
They did. They laid out 4 main factors that converged in Q2, sort of a perfect storm, as you said earlier.
All right, let's break them down. Factor number 1.
Gas mix shift. Simply put, they started running out of the cheaper gas as their overall demand went up. Their allocation of the government-administered price gas, the APM gas, didn't keep pace with their growth. And specifically, the allocation of another cheaper source, New Well Gas, or NWG, dropped quite a bit from about half an MMCMD down to around 0.35.
So with volumes booming, especially in I&C, they couldn't cover it all with cheap domestic gas anymore.
Precisely. They had to blend in much more expensive imported gas spot RLNG bought via the exchange, and also their term HPHT gas. This pushed up their overall weighted average cost of gas significantly. We're talking about 70-75 pays per SCM just from this mix shift.
Okay, that's substantial.
Yeah.
Load factor number 2.
Currency, the exchange rate. The rupee weakened against the dollar by about 2 rupees on average between Q1 and Q2, since a lot of their term gas and spot purchases are dollar-linked.
Their costs went up just because of the exchange rate.
Yep, pure external factor. That added over 50 pays per SCM to their costs in Q2 compared to Q1. So 75 pays from the mix, 50 pays from the currency.
Already looking like a big hit. What was the third factor?
A regulatory tweak. The mandated blending of compressed biogas, CBG, under what's called the uniform base price. This effectively made even the cheap APM gas, they did get slightly more expensive. It added about 22 pays per SCM to the cost of that APM basket.
Okay, so 3 cost side pressures, mix, currency, and a regulatory nudge on APM price. Was there anything on the revenue side?
Yes. Factor number 4, realization drop. This specifically hit the I&C segment, the one that was growing so fast.
The success story segment.
Ironically, yes, the benchmark alternative fuel for many industrial customers is bulk LPG. And during Q2, market prices for bulk LPG softened quite a bit.
So MGL had to lower its own I&C prices to stay competitive against cheaper LPG.
Exactly. To hold on to those customers and maintain that impressive volume growth, they had to sacrifice some margin in the I&C space. Management indicated this cost them over 2 rupees per SCM in realization just within that segment.
Wow. Okay, so it really was a combination, punch costs rising from multiple angles and revenue per unit falling in their fastest growing segment due to market competition.
That's the picture. Volume growth came at the cost of unit profitability in Q2.
So understanding that, what's the path forward? How do they plan to stabilize these margins? You mentioned the expensive spot gas. Are they locking in better deals?
That's the core strategy. Their current gas sourcing is, let's say, complex. It's a mix. You've got the APM gas for domestic PNG, around 1.7 MMS CMD, then Henry Hub-linked term gas, maybe 1.45, some HPHT term gas around 0.6, the shrinking NWG at 0.3, and then the variable expensive spot LNG from the exchange, which was maybe 0.3 to 0.4 MMS CMD in Q2.
So reducing that spot exposure is key.
Absolutely. Management is focused on securing more long-term contracts to replace volatile spot buys. The big one they highlighted is a potential large long-term HPHT contract.
HPHT, high-pressure, high-temperature gas.
Yes. They're hopeful this contract, potentially for 12 million units, could start flowing around January 2026. If that materializes, especially hitting in Q4 of this fiscal year, it should provide significant cost relief and stability.
That sounds promising for early next year.
Yeah.
What about now? Are they just absorbing these higher costs, or are they passing them on to consumers?
Price hikes. They're trying to balance it. Management was clear they are cautious, especially with CNG prices, because they don't want to kill the volume momentum. But they aren't absorbing everything. They confirmed they took some marginal price increases in the last quarter and specifically mentioned another 50 pays hike implemented in October. So some pass-through is happening, but carefully.
And has this Q2 experience changed their outlook on what a normal margin should be?
It seems so. They subtly revised their guidance. Previously, they often talked about a comfortable range of 9 to 10 rupees per SCM EBITDA. Now they're suggesting that for Q3 and Q4, maybe 8.5 to 9 rupees per SCM is a more realistic, comfortable range.
So accepting slightly lower unit profitability to keep the volume engine running.
That appears to be the strategy, yes, reflecting the current market dynamics and cost pressures.
Before we look further out, let's quickly circle back to that UEPL merger. You said it changed the scale. Was there any immediate financial sweetener from the deal, besides just bigger numbers?
There was one specific benefit they called out, a tax advantage. Because of the amalgamation structure, MGL could claim depreciation on the value of the licenses transferred from UEPL. They estimate this will lead to a tax saving of around 35 crore rupees over this fiscal year and the last one combined.
Okay, so a nice little cash flow boost from the merger structure itself.
Helps cushion things a bit.
All right, let's shift gears to the longer term. City gas, transport. You inevitably have to talk about electric vehicles. EVs. It always feels like this looming threat, particularly in a state like Maharashtra with EV policies. How does MGL view this?
Yeah, it's the perennial question. MGL's management, however, sounds, let's say, quite measured about the immediate EV impact, specifically within their core Mumbai region.
They don't see it as a major near-term threat? Why not?
Their argument centers on the specific conditions in Mumbai. They point to things like, 1, extremely high parking density, where do you reliably charge? 2, the lack of widespread, easily accessible charging infrastructure. And 3, a crucial point for commercial vehicles like auto rickshaws. Many operate on a driver shift basis.
Meaning the driver doesn't own the vehicle.
Right. The owner might have multiple drivers using it around the clock. That model doesn't lend itself well to overnight charging or taking the vehicle out of service for hours to charge. They note that EV penetration in Mumbai's three-wheeler segment is currently negligible.
So practicality and infrastructure hurdles are limiting EV uptake in their key market, is the argument.
That's their case. They also argue CNG still wins on running costs and fuel efficiency compared to petrol diesel, and the upfront cost is much lower than EVs. So their strategy isn't ignoring EVs, but focusing on making CNG attractive now through things like fleet programs and fuel cards, focusing on usage incentives, not fighting the capital cost battle.
Interesting perspective. And alongside defending CNG, they're dipping their toes into new areas, right? These investments in a battery company, an EV maker, and an LNG venture.
Yes, they've taken equity stakes in International Battery Company India, IBC, 3EV Industries, and formed a retail LNG joint venture.
Are these going to move the needle financially anytime soon?
Not in the short term, no. Management was clear on that. Take the IBC investment, it involves significant capital, maybe 800 crore for a 1 GW battery plant. Down the line, that could generate substantial revenue, over 1,000 crore potentially, but that's years away. For the next, say, 3 to 5 years, these ventures are primarily balance sheet items investments. They won't significantly impact MGL's consolidated top line or bottom line derived from the core gas business. It's about future-proofing, planting seeds, not immediate diversification of earnings.
Okay, so let's try and pull this all together for you listening. It seems MGL had a quarter of contrasts. Really impressive volume growth, especially finding new industrial customers. But that growth, combined with rising import costs, a weaker rupee, and competitive pressure, led to a sharp squeeze on profitability in Q2 once you adjust for that Q1 one-off gain.
That sums it up well. The immediate fix hinges on securing that large, long-term HPHT gas contract expected early next year to reduce reliance on volatile spot markets. Until then, they're walking a tightrope, prioritizing volume and infrastructure build-out, even if it means accepting slightly thinner unit margins for a while, passing on only cautious price hikes.
But we should also remember those lingering legal issues, shouldn't we?
Absolutely. It's important context. There are still significant contingent liabilities hanging over them from long-running disputes. The UTN-GPL tariff case is a big one. And also issues around GST on reverse charge mechanism. We're talking over 300 crore rupees potentially at stake.
MGL seems confident in their legal position.
They express confidence, yes. But recovery or final liability depends entirely on court decisions. The next hearing for the UTN-GPL case, for instance, isn't until February 2026. So those are unresolved clouds on the horizon.
Which leads us to a final thought for you to consider. Management is clearly betting on growth, pushing volumes even when unit margins dip to that 8 rupees per SEM level we saw in Q2. They believe long-term contracts will eventually bring costs down. But the question is, how long can MGL afford to prioritize this expansion drive over protecting unit profitability, especially if global gas prices remain volatile or rise further? At what point does the pressure force a more aggressive price hike, potentially slowing down that very growth engine they're trying to fuel? Something to ponder. Thank you for joining us for this deep dive.
We look forward to exploring the next set of sources with you soon.